I'm very glad to welcome today Jamil, Managing Director, Head of Client Solutions and Analytics at PIMCO, one of the leading asset managers worldwide. Welcome, Mr. Bass.
Thank you, Peter.
Today we want to talk about the fixed income market and the consequences for investors. So my first question, what are the main features of the current investment outlook?
Okay, so if we step back a little bit and forget about equity and fixed income for a second, I would say the salient characteristics of this market are that, number one, it's not the news that make the markets. It is the markets that make the news. In other words, we are in a world where economics matters less than finance. And the reason for that is very simple. Wealth now represents about 7 times GDP. So whatever happens to the markets is going to impact substantially the economic outlook, while the reverse is not necessarily true. So that's the first characteristic. Markets make the news, news make the markets much less. Second thing is that valuations are close to an extreme. Okay? And we will discuss this a little bit later, but if you look at the granddaddy of asset markets, meaning the S&P 500, and look at the basic valuation ratios for the S&P 500, meaning price to cyclically adjusted earnings, price to sales, price to replacement value, price to GDP, price to anything will give you about the same answer, that the S&P 500 is very close to expensiveness extremes. That's point number 2. And point number 3 is that I find the market to be too relaxed considering the first 2 points. If you think about how the market is positioned, I would say that the market is implicitly short volatility. Not in a technical sense, but it turns out that you can be short volatility in a variety of ways. For example, the governments are short guarantees, and more so. If you are into a risk parity fund, if you are tracking a value at risk measure in your risk management, if you are in buy the dip mode, all those are short volatility positions, implicitly short volatility positions. And who says short volatility says that the market is at high risk. So that's the situation where we are today.
And how do the investors need to think about the bond equity allocation?
So if I wanted to give a very summary rule of thumb, it turns out that a very simple way to think about your asset allocation in a world where there are only equity and bonds is that you should basically allocate to your equity 10 times the equity risk premium. It follows from a very simple rule called the Merton rule. And if you apply that rule today to the US market, it turns out that the equity risk premium is extremely low. It's less than 1% of order 80 basis points, when historically it's been closer to 5%. Which means that if you allocate 10 times the equity risk premium, you should be allocating less than 10% to equity and more than 90% to fixed income. I know this sounds very extreme, but that's what the rule of thumb of asset allocation will tell you. Historically, with 5%, you'd be in a 50-50 portfolio. Today, at 80 basis points, you should be much less invested in US equity if you are a US investor. If you are a European investor, though, the good news is we're much closer to some kind of equilibrium, because in Europe and in the UK, the equity risk premium is closer to 4 to 5%. So there you can afford a more normal asset allocation of 40 or 50% to equity.
And should investors prefer active or passive solutions in their fund selection?
So that's obviously a very important topic, but when you think about that topic, I think it's essential to look at the data. And we have done a study where we looked at about 13,000 funds from the Morningstar data set. And what have we found? When it comes to active versus passive in equity space, we found that passive by and large beat active in equity. And then we went on and decided to look at the bond universe. And when we did that, to our surprise, we found exactly the opposite results. In bond space, most active players tend to beat their median passive counterpart. Why is that? Because in fixed income, much more so than in equity, you have what's called constrained players. Think about central banks which buy bonds actively, but not so much to optimize returns. They do this, say, for quantitative easing purposes, to flatten the yield curve, to depreciate their exchange rates, to boost GDP, even to boost equity markets. But in the process, there's a lot that they don't do, okay? And so there is a transfer of alpha, there is a transfer of returns, if you will, from the constrained players to the unconstrained players, meaning the mutual fund, fixed income, active investors. And that's why what we're finding is that in fixed income, there seems to be an advantage, an alpha advantage to being active. So to that extent, yes, we would recommend substantial active allocations to fixed income.
What are the main differences between public and private asset allocation?
So again, another difficult question. Traditionally, of course, people have been into public allocations, but these days, obviously, with the prominence of private equity and private debt, there's a lot of thinking that's going into this. One first order of reference is to say that private generally earns more than public, and the difference is a so-called liquidity risk premium. What we find is that the liquidity risk premium is somewhere between 100 and 200 basis points. So to the extent that you, as an asset owner, can afford to have more private equity, you should do that. I mean, the first question you should ask yourself is, what percentage of my assets under management do I need to be liquid over the next 3, 5, 10 years? And to that extent, that determines your private allocation. Now, within the private allocation, I think there are a couple of interesting things happening. The question is, what is the relative value between private equity and private debt? Well, in exactly the same way as, like we just mentioned, equity seems to be quite expensive to bonds in public space. It turns out that private equity is quite expensive to private debt for a variety of reasons. If you look at the beta of private equity, that's small caps turn out to be expensive to the beta of private debt, which is high yield. If you compare the two yields of high yield versus small caps, it turns out that high yield offers much more interesting returns. That's one thing. Second thing is that you observe empirically that private debt managers tend to generate higher alphas than private equity managers, and that may have to do with crowding, but may have to do with many other factors that we don't have the time to expand upon here. So what we find typically is that even though people are more allocated to private equity than to private debt, in good financial logic, it should be the other way around. They should be more allocated to private debt as opposed to private equity, which is exactly the same result we found in public space.
Mr. Bass? Thanks a lot for the very interesting insights to the bond market.
Thank you very much, Peter. Thank you.